Everyone's talking about the housing crisis like it's one story. Mortgage rates, home prices, Wall Street landlords. But there's a quieter story hiding underneath all of it. One where the villain isn't the federal. It isn't Wall Street. It isn't even your landlord. It's your insurance company. And by the time most homeowners realize what's happening, it's already too late. The bill just showed up. Today, we're breaking down how climate risk quietly became the biggest hidden cost in American housing, why insurers are pulling out of entire states, and who's actually cashing in while everyone else pays the price. Let's start with the number that should be the headline every single day. Home insurance premiums have jumped nearly 30% in just the last 2 years. That's not inflation. That's not a normal housing market swing. That's a structural shift in what it costs to own a home in America. And it has almost nothing to do with the price of the house itself. Here's the part that surprises people. Your insurance premium doesn't care what your house is worth. It doesn't care about your neighborhood school rating or how close you are to the subway. It cares about one thing: risk. Wildfire risk, hurricane risk, flood risk, storm risk. And in 2026, that risk is being repriced in real time all over the country. Nebraska, Kansas, Oklahoma, Louisiana, Florida. These are now some of the most expensive states in America to insure a home, right alongside California. Not because the houses are fancy, because the weather is getting worse, and the insurance industry has finally stopped pretending otherwise. Here's where it gets interesting. When insurers realize a market isn't profitable anymore, they don't announce it with a press conference. They just leave, quietly, state by state, non-renewal by non-renewal. Florida and California, two states with completely different climate threats, hurricanes on one coast, wildfires on the other, have both watched major insurers either stop writing new policies or exit entirely. Homeowners who've paid premiums for decades are getting letters saying their coverage won't be renewed. Not because they filed a claim, because their zip code did the math for them. And when private insurers leave, someone still has to cover these homes, because almost every mortgage in America legally requires insurance. So states step in with what's called a FAIR plan, a government-backed insurer of last resort. Sounds like a safety net, right? It's not. FAIR plans typically offer less coverage for more money. They exist so people can technically comply with their mortgage, not so they're actually protected. And in over 30 states now, this last resort has quietly become the primary option for entire neighborhoods. This is where the story stops being abstract. Picture a homeowner in a coastal Louisiana town. Bought the house years ago. Mortgage is manageable. Property values actually gone up. But the insurance bill hasn't just gone up. In parts of the state, it's eating 30 to 40% of what used to be an affordable mortgage payment. That's not a rounding error. That's the difference between owning your home and losing it. And this is the part almost nobody frames correctly. Rising insurance costs are now directly causing foreclosures. Research from climate risk analysts has found that for every 1% increase in insurance premiums, foreclosure rates rise by roughly the same amount nationwide. Climate-driven foreclosures are still a small slice of the total today, but the same research projects that slice could nearly quadruple within the next decade. That means the home you think is worth $1 million on paper might functionally be worth a fraction of that, because the true cost of holding onto it is climbing every single year, and nobody's pricing that risk into the home value number you see on Zillow. So if homeowners are losing and insurers are fleeing risky markets, who's the winner here? Follow the money. When private insurers exit, one of two things happens. Either the state-backed FAIR plan absorbs the risk, spreading the cost across every taxpayer and policyholder in the state, or the insurers who stay simply charge whatever the market will bear because there's less competition left to keep them honest. Meanwhile, the reinsurance market, the companies that insure the insurance companies, has been raising its own prices aggressively in the background. That cost gets passed straight down to your premium. It's a chain reaction, and at every link, someone's taking a cut before it reaches your mailbox. The homeowner absorbs the risk of the climate event. The insurer absorbs some of it, then passes the rest upstream. And the reinsurers and the companies pricing catastrophe bonds on Wall Street, they're pricing climate risk with more precision than almost any other part of the economy right now, because they have to. It's their entire business model. In other words, the private market has quietly become the most honest voice on climate risk in America. It's just that honest here means expensive, and homeowners are the ones footing the bill for that honesty. To be fair, this isn't going unnoticed. In 2026, at least 18 states have introduced legislation to reform how insurance risk gets priced and managed, building resilience incentives into the system instead of just letting premiums spiral. Colorado's been the model a lot of other states are copying, a law that ties disaster risk models to actual mitigation efforts, like homeowners hardening their roofs or clearing wildfire brush, so the data reflects real risk reduction, not just raw exposure. But here's the honest take. Legislation moves slower than weather does. Even the most well-designed reform takes years to show up in actual premiums. And in the meantime, the burden overwhelmingly falls on homeowners, insurers, and taxpayers, not on the underlying source of the risk itself. So states are playing defense in a game where the other side keeps changing the rules. Here's the uncomfortable truth underneath all of this. America has been pricing homes based on location, square footage, and school districts for 100 years. That model is breaking down in real time because there's a variable it never accounted for: whether your house can survive the next decade of weather. Insurance companies aren't the villain here. They're the messenger. They're just the first part of the system forced to price climate risk honestly, because the alternative is going bankrupt. The real question isn't why are premiums so high? It's what happens when an entire housing market, mortgages, home values, generational wealth, was built on the assumption that this risk was free, and it turns out it never was. That bill is coming due. And right now, insurance companies are the only ones in the entire housing economy actually collecting on it. If you want to see whether your state's on the list of places getting quietly repriced, drop your state in the comments. I'll probably cover it in a future breakdown.